Our next guest is almost in the same camp as JPM, saying the risk of recession is above 50%. And with stocks under pressure for the second day in a row, let's bring in Charlie Babrinskoy, the vice chair at Ariel Investments. Charlie, you've got a long experience in the markets. You're supposed to be telling us to buy at times like this, right?
As a long-term investor, I'm going to say we should hold at these times. This is what long-term investors do. They don't panic when times are down. They don't sell when stocks are lower. But if you need your money in the stock that you have in stocks and you're going to need it in the next 6 to 12 months, I would advise caution. This is not just the market having a panic. This is bad policy having bad effects. The stock market is all about things happening versus expectations. And the expectations were that we would get an administration that was very pro-business, that would be good for the market, lower taxes, lower regulation, more approved mergers. Instead, we're getting some policies that are extremely bad for business. And that, in my opinion, is why we haven't justified sell-off of the market.
So are you juggling things around, Charlie, in the portfolio?
I haven't made a lot of moves because the news is fully reflected in stocks. And so the names that are going to be hurt by tariffs are being hit hard. I will say the area that's been, in my opinion, hit probably a little too hard are regional banks and even some larger banks. Banks obviously aren't importing products that are going to be tariffed. Banks would be hurt by problems in credit, and we're not seeing that yet. So names like Bank of America and Bank of Oklahoma that have traded down in a big way, I am more positive about. There are some names in healthcare that have been hit very hard because of what Cabinet Secretary Kennedy has proposed. And so maybe some of those healthcare names are oversold. But I don't want to minimize what's going on here. Tariffs are, in this kind of tariff, very bad policy. They're going to have a real effect on the economy.
You know what's so fascinating, Charlie, is the amount of retail buying that we're seeing. Did you hear those data points earlier? Big retail volumes buying into this market sell-off yesterday. What do you think that's about? And the retail, by the way, going back now to the pandemic, they've kind of been the smart money, right? They were buying in the March 2020 lows. We don't have to get into the Momo stocks and whether those have always worked out so well. But what do you make of this discrepancy where we have, it seems, retail buying into the sell-off while pretty much every investment pro economist we talk to is pretty bearish?
Yeah, I think the retail investor has been taught to buy the dip. Look, if you bought stocks on dips anytime over the last 15 years, you've done very well. And so I support that basic instinct. That's better than the opposite, where people would panic and sell on the way down. But I do just want to stress that this is not a temporary phenomenon. If we're going to have less globalization, if we're going to have tariffs, significant tariffs, that's going to be bad for the economy for a while. And so I don't want people to think this is just the market having an emotional reaction. These are bad policies. And now we still all have the same hope, which is that Mr. Trump will be able to recognize some victories. He'll be able to get some major company to drop some major country to drop their tariffs, and he will announce a victory. That can still happen, but this is worse, much worse than any of us thought.
So even companies like Nvidia, right? You say for all that's happening, the AI boom, the AI innovation cycle is clearly going to be moving forward. Those shares are, I think, 30% off their highs. They're below 100 now. Is there a level at which they or an Amazon or some of these other almost defensive, stapley kinds of big tech investments make more sense to you to get involved here?
And I'm glad you brought those names up because there were names going into this that were overpriced. The Magnificent Seven, everybody's talked about, it's not an original thought from me, were overpriced. And so some of them have just now gone into correction. But what I'm more focused on is the names that were reasonably priced before this all happened and have now been hit almost as hard. They haven't been hit quite as hard. But you have to be careful about that. I would say some of the names like NVIDIA, some of the AI stories are coming back down to earth because the companies won't be able to spend in CapEx to advance their AI strategies in a recession the way they would if the economy was going on all cylinders.
It has been impossible to stop Nvidia. The biggest data centers in the world now value its chips, which have long been the go-to option for video gamers. The chip maker's yearly income has increased from $4.7 billion to $130 billion during the past 10 years. This year, Nvidia's stock's explosive growth came to a halt as investors considered the impact of tariffs on chip consumption, as well as heightened competition and other hazards. In the first quarter, the stock fell 19%. Chips from Nvidia are still in high demand. The recent decline in the price indicates that some investors are questioning if analysts' full-year revenue projections, which call for a 57% gain, are achievable given the impending challenges. Should investors wait or begin a stake while the stock is down? All of the top cloud service providers use graphics processing units, GPUs, of which Nvidia is the major supplier for data centers. In the fiscal fourth quarter, its data center revenue increased 93% year over year, with over half of its data center business coming from top cloud services. During the quarter, Nvidia's new Blackwell computing system brought in $11 billion. During the fiscal Q4 earnings call, CEO Jensen Huang stated, "We will need to keep growing because demand is very high and customers are eager and impatient to receive their Blackwell systems." These demand trends make the stock's value appear quite alluring. The shares are trading at about 24 times this year's consensus earnings projection, which is much less than the stock's trailing price to earnings, PE, multiple of 80 during the previous 5 years. For a high-growth company, a low PE can frequently indicate undervaluation and pave the way for large profits. The possibility of more competition is one factor contributing to the stock's decline. Given that it is the primary provider of artificial intelligence, AI processors, Nvidia's astronomically high 56% profit margin indicates that it is setting its chip prices as high as the market would allow. Although this boosts Nvidia's earnings, some of its clients may decide to hunt for less expensive options. To reduce reliance on Nvidia, for instance, ChatGPT model maker OpenAI is allegedly creating its own AI hardware. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Chip makers escaping specific tariffs as President Trump announces new levies on imports to the U.S. Still, chip stocks getting dragged today along with the broader market. Joining us now, Stacey Rasgon, Bernstein's managing director and senior analyst. Stacey, great to speak with you. You say that semiconductors will still feel an indirect hit from these new tariffs. How are you calculating the impact here? What does that look like?
You bet. So semis, they will get hit by the baseline tariffs, this 10%, although I would say we don't import that many raw semiconductors anyways. It was $82 billion worth of raw semis in 24, and not a lot from any single country. I think Malaysia and Taiwan where they were most, but even then was $16 billion from each. A 10% increase. Semiconductor ASPs are up 50% over the last 5 years anyways. That's okay. The issue is the indirect. The products that the semiconductors go into are going to get hit by tariffs. And that's the thing. Most semiconductors come into the U.S. inside other things like PCs, like smartphones. And you can actually look like where is the U.S. importing things like computer hardware and smartphones from. And just to level set you, in 2024, the U.S. imported close to $200 billion of compute hardware, servers, PCs, that sort of thing. About $114 billion of smartphones were. And if you sort of look at the locations and then the tariffs that are coming from those locations, my math suggests something like close to a 40% tariff on computing hardware and smartphones that the semiconductors are going into. Cars as well. We did $350 billion of vehicles and vehicle parts in 2024. Those will get hit by a 25% tariff. And so the issue really is not so much the direct impact. It's as these products now get more and more expensive, is their demand destruction.
Yeah.
If we're selling fewer of the products that the semis go into, that's the bigger risk. The other risk for semis is just they're very cyclical and very global, and they're very correlated to the macro, to GDP. So if this tips us into recession, that's probably not going to be great. And so that, I think, is where the semiconductor stocks are actually moving, rather than like worries about like the direct impact of the tariffs themselves.
Yeah, Stacey, which is worse for chip stocks? A tit for tat on tariffs that allows for them to continue to get worse, or a scenario where companies just sort of pause across the board on spending as they wait for those negotiations to unfold and hopefully get better?
Well, I mean, I think those two things are coupled, right? They're not independent. And they're all, and by the way, this isn't just semis, by the way. I don't think there's any sort of good news really for anybody out here. So this isn't specifically a semiconductor related issue. This isn't an everybody issue. But yeah, I mean, if you're worried about escalation, both from other countries as well as from the U.S., that becomes a problem. And I think the point you make just about like paralysis is a very interesting one and very true. I mean, like this is part of the issue. Like, how do you make plans that are going to take years potentially to put into place? Like, if we want to bring facilities and infrastructure back to the U.S., how do you make plans if you're not sure what like next week is going to bring on the stuff? Or people may even just wait if you've got a project that's going to take like 3, 4, 5 years to bring to fruition. Anyways, this administration will be out of power by then. Do you just decide to wait until the next one? Maybe everything comes off. So that just the general worry about decision paralysis, I think, is a big one. And again, for semis, and I think also like for broader for the broader industries as well.
Nvidia still has a lot of resources to keep coming up with new ideas in order to keep up the momentum. During the most recent earnings call, management stated that the growing popularity of models such as OpenAI's ChatGPT is driving up demand for AI inferencing. Nvidia's business may benefit greatly from inferencing. Here, a computer can predict and finish a task without assistance from a human. Although it demands 100 times more processing resources per work, it is the next step in the development of AI. Blackwell from Nvidia was created to satisfy this need. Every business has risks, and Nvidia is undoubtedly experiencing some of them. Although it is yet unclear how tariffs would affect the top chip makers, pressure on the rest of the economy may have an effect on the chip business, which has a history of fluctuating with the economy. In China, where sales of Nvidia's data center chips are still far lower than those recorded when chip curbs were initially implemented in 2022, the business is likewise struggling with chip restrictions. However, a comparatively modest portion of Nvidia's business is conducted in China. While Alphabet's Google and Amazon have been creating their own chips without affecting Nvidia's momentum, OpenAI's desire to produce its own AI chips is a risk to watch. Two of Nvidia's largest clients are still these IT behemoths. The raw power that Nvidia's GPUs offer for creating humanoid robots, training self-driving cars, and creating sophisticated AI models cannot be replaced. According to its most recent earnings report, Nvidia is expected to have another year of rapid growth. It predicted that fiscal Q1 revenue would increase by almost 65% on an annual basis. The stock is currently providing good value, but investors shouldn't overlook the hazards. Although it's prudent to size your investment for the likelihood that one of these hazards materializes, I would still purchase the stock. It's a deal when the stock is trading at 24 times forward earnings, revenue is increasing at high rates, and customers are eager to purchase the goods. The stock of Nvidia may increase in value over the coming years if the company's long-term profits growth projections of 35% on an annually basis are met. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
How should investors balance the concerns about near-term demand destruction with the prior excitement around the long-term structural theme of artificial intelligence?
Yeah, well, I think that theme is probably still real and still there. Again, we'll see if any of this stuff has any near-term implications for CapEx spending and that. But I think AI is actually one of the themes that, like, through this probably can work. And frankly, if we want higher productivity and everything else, we may need something like that anyways. I think in the near term, none of that is going to matter. Though, like I said, this is going to overpower near-term decisions. Like, everything is going to get whacked. Multiples in general are going to come down. Like, I mean, just we're in an environment where, uncertainty is going to be higher. Cost of capital is clearly going to be higher. Multiples are going to come down. And we'll have to see where that bottoms. I think part of the other issue is, I mean, like, on the surface, like this, it seems stupid and self-inflicted, right? And so you have to sort of wonder as to the mindset of the folks who are in charge, who are like bringing a sledgehammer to this. It is going to make people concerned, again, broadly about like what sort of discount factor to put on those future cash flows. And that's what we're seeing today. Like, it's not like earnings and everything all get revised like necessarily today, but like multiples are clearly going to come down, and semis are going to get hit by that just like everybody else will.
Well, to that exact point, Stacey, Nvidia was cut to hold at HSBC this morning off the back of concerns that they have limited pricing power, and that's going to be a hit to earnings. Where do you stand on that argument?
They have limited. I'm not sure they have limited pricing power. I'm not sure. They have. I mean, they're running 75% margins, and frankly, people are lining up out the door to buy their products. They probably have more pricing power, frankly, than anybody else. Although I would say semiconductors in general do tend to have pricing power. Again, you can look through COVID just because of the inflationary pressures. The average semiconductor ASP today versus, say, 2019 is up 50%. So I think the industry, and by the way, people still bought semis. I think the industry in general probably does have better pricing power than a lot of other industries. Like if I was selling T-shirts or shoes or something, I would be more worried about my ability to price the tariffs versus like semiconductors, especially if it's like a 10% lift. I'm not too worried about that. I think the broader disruption, and like I said, the worry about demand destruction at the end unit point is I think bigger worries. And I don't think those are isolated to NVIDIA. I think those are broad worries across the space.
I think I'm still sitting here with an iPhone 6, so I might be part of that problem. What do you think, what's an expectation for what the damage may look like, and how excited do you get around where valuations may be going on some of these great long-term theme names?
Yeah, I to be honest, I don't know like how big the damage will be. Again, if it was a direct impact, you can size that. We've done that. It's fine. The indirect impacts and demand destruction, I don't know, because you need data on price elasticity for a gazillion types of end products. Like I don't have that data or analysis. I don't know exactly how to size the general impact from this. It will, again, if this continues, and the macro gets worse, it'll probably be sizable. And again, not just semis. Again, I don't think this is isolated to semis, but the impact will probably be big. So I don't know how to size it though. I wish I did.
The latest market sell-off has affected some of the world's top corporations, including Nvidia. As of this video, the stock is down almost 25% from its peak earlier this year. Nonetheless, the stock now offers a good opportunity to buy due to this downturn. Let's examine 3 compelling arguments for why investors should purchase the stock now. 1. Nvidia is a cheaply available growth stock. Due to the recent decline in the stock market, Nvidia is now valued at a very appealing level. According to expert projections for this year, it currently trades at a forward price-to-earnings ratio, PE, of just 24.5. Its price-earnings-to-growth, PEG ratio, is below 0.5, but that's not all. A multiple below 1 is typically regarded as inexpensive, and PEG ratios account for a company's growth. Because of this, Nvidia's stock is incredibly inexpensive when you consider its prospects for growth. In recent years, Nvidia has emerged as one of the leading growth stocks. Over the last 2 years, its revenue has increased by 383%, from $27 billion in fiscal 2023 to $130.5 billion in fiscal 2025, which concluded in January. A business the size of Nvidia rarely doubles its revenue in 1 year, and then doubles it again the next year. In the meantime, 2025 is anticipated to see its robust sales growth continue. The company's sales is predicted to increase by 54% this year to $204.4 billion, and by over 24% in 2026 to $252.4 billion, according to analysts. Nvidia predicted that its fiscal Q1 revenue would increase by 65%, but it has not provided any full-year guidance. 2. The moat around Nvidia's company is broad. With a market share of more than 80%, Nvidia is the undisputed leader in graphic processing units, GPUs. The original purpose of GPUs was to accelerate video game graphics rendering. But because of their speedy processing of large volumes of data, they are now the foundation of artificial intelligence, AI infrastructure. The chips are ideal for managing the demands of AI workloads because of this and their high memory bandwidth. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Look at some big tech. NVIDIA, I think, Jenny, maybe we go there first. It's down 7% right now. Sub $100 NVIDIA.
Sub $100. That's the first thing I saw when I woke up this morning is on X. Everyone was talking about how now there's always an interesting opportunity. I mean, many people are saying that this is going to be like the greatest FOMO trade of the year if we start to see some upside. I mean, I guess I'm hoping for that. I'm hoping that we see things not just continue to tank every single session, but when you look at the stocks right now with the highest revenue exposure to China, Nvidia is not the top of this list. I mean, you have like Las Vegas Sands, Qualcomm, KLA Corp, but Nvidia's in the top 7. So it does have about 17% of its revenue directly exposed to China, about 22% revenue exposed to Taiwan. And what we see from the overall total Asia region, it is about 40%. So yeah, that is substantial, no doubt. I also think that right now, when regards to like the AI trade specifically, Nvidia is the one I would make the most argument on, is that nothing in terms of its growth story has changed yet. We're just basically selling off on the expectation that we see supply chains get hit, we see Blackwell-faced delays, we see competition come in and be able to eat their market share. Like that's, I think, the worst case scenario right now. But as far as like everything that their CEO and overall management has said, I mean, even just a few weeks ago, I know we didn't know the full extent yet, but Wang was saying that, hey, we're pretty optimistic on tariffs. We've been able to weather the storm before. So his tone was like, yeah, we're ready. I mean,
rock and roll.
I think that this has been the most detached from the fundamental sell-off of Nvidia of like any of our Mag 7, because frankly, the narrative has at least still been positive if you're looking into the long term, like the greater scope of its growth.
I think the biggest tariff impact on Nvidia is going to be the threads in those leather jackets. How much of the price of those is going to go up from, he might have to get some studs on those because this chart is really getting beat up, Rick.
Yes, you know, I was just saying yesterday that at least Nvidia was still holding above this green line here, 101.52, that represented not only the low point after this gap up, but also a series of lows. We did have these other anomalous lows from August 5th to watch out for now, because now those are in the picture, actually, because we have broken down through that key supportive level. Notice as well that we also had more of a falling wedge type shape between our two white dashed lines. Now we have also broken through that area to the downside, typically regarded as a more bullish pattern, but as you can see, it's certainly not a guarantee. What you're looking for in these situations is a breakout beyond either of these two boundaries. That's what triggers the rush of orders and delivers the breakout potentially. So now the area to watch, 90.69 was that low point from August 5th. We can see that RSI is now entering the oversold area as well, typically regarded as a sign of weakness when a market is trending strongly. So perhaps another more bearish sign to consider. So if we were to add our other studies, standard deviation channels and volume profile, we can see that up here we gave up a lot of key technical indicators. This was a serious resistance area near like maybe 114 to 118 or so. We've faltered from there. We've fallen below our -2 standard deviation channel, 2 standard deviations below our linear regression line. So that area near 103 now is resistance. To the downside, volume node here near about 90, pretty close to our -3 channel as well. So really quite a fall from grace here. A precarious move lower now beyond this support that many people probably were hoping would hold up there.
Absolutely. Closing this big gap from earnings.
Yep. Mm-hmm.
So, maybe some support here with that little volume node above the 90. So maybe there's one little spot there, which is kind of where we're at, but it's not looking good.
With its CUDA software platform, which it developed to enable its chips to be programmed for purposes other than their original design, Nvidia has distinguished itself in the industry. Nvidia has a significant advantage in this field because its closest rival, Advanced Micro Devices, didn't release its own software solution to program its chips until roughly 10 years later. Since then, the business has developed CUDA-X, a set of libraries and tools built on top of CUDA, which enables developers to make better use of its products for AI applications. Recent testing by semiconductor research firm SemiAnalysis revealed that AMD's GPUs were unsuitable for AI training right out of the box because of software flaws, demonstrating the moat that Nvidia has built, and that this eliminated any potential benefits their GPUs could have had on paper. The performance of Nvidia's GPU was described as amazing right out of the box, with little technical assistance from Nvidia engineers. 3. The winner of AI infrastructure is Nvidia. Spending on AI infrastructure is currently Nvidia's top priority due to its vast moat. Because of its large market share, the company is well positioned to prosper as long as expenditure on AI data centers keeps increasing. Training AI models on more and more varied data sets is currently the only way to greatly enhance them. More processing power is needed for this, and AI chips, in particular GPUs, provide it. The number of GPUs utilized to train AI models has sharply increased as these models have developed. Two of the greatest publicly available examples are the Llama and Grok models from Meta Platforms and xAI, respectively. The most recent iterations of these models require 10 times as many GPUs for training as their predecessors. As they seek to increase capacity to meet the demand for AI workloads, cloud computing businesses are among the largest purchasers of GPUs. Apart from creating their own AI models, these businesses essentially offer AI as a service, giving developers access to machine learning frameworks, pre-trained foundation models, and APIs so they can incorporate AI into their already existing products. In order to meet the increasing demand for these services, the three major cloud computing businesses will together invest around $250 billion this year to develop their data center infrastructure. While OpenAI, the company behind ChatGPT, has announced plans to invest $500 billion in data center capital expenditure over the next few years through the Stargate project with SoftBank and other companies, other tech companies, including the previously mentioned Meta and xAI, are also investing heavily in AI infrastructure and developing AI models. Meanwhile, big businesses across a range of sectors are also investing in AI infrastructure, frequently implementing a hybrid cloud strategy that combines cloud services and on-premise technology. Nvidia anticipates spending more than $1 trillion on AI data center infrastructure by 2028. Nvidia's stock has a lot of room to grow if that occurs.